Have you ever wondered if you could just bottle up the genius of a world-class stock trader? Take all that intuition and gut feeling and somehow turn it into code? What if you could actually teach a robot to trade like a legend? Well, today we're diving into a fascinating experiment that tried to do exactly that.
We're going to break down this incredible university research paper by Patrick Torin, who took on this exact challenge. This is a story of man versus machine, an attempt to clone a legendary trading strategy with an algorithm. And the results? Let's just say they were not what anyone saw coming.
So, the wizard in our story is a guy named Mark Minervini. And this quote from the researcher pretty much tells you everything you need to know about his reputation. Minervini isn't just some flash in the pan. He's a two-time U.S. investing champion. Back in 1997, he famously pulled off a 155% annual return. That's the kind of magic this whole experiment was trying to capture.
Okay, so how on earth do you even start to translate a master's complex strategy into cold, hard code? Well, the first step was to take the most black and white part of Minervini's method, how he finds a stock that's already got incredible momentum.
At the absolute core of this whole thing is a concept called the Stage 2 advance. Now, forget about buying stocks that are beaten down and hoping they recover. Minervini's whole philosophy is about buying stocks that are already strong, that are in a clear, powerful uptrend. You're not trying to catch a falling knife. You're jumping onto a rocket that's already mid-flight.
To find these rockets, Minervini uses a really specific checklist, and this is exactly what the researcher programmed into the algorithm. The first 6 rules are all about confirming that powerful, established uptrend. The code checks to see if the stock's price is way above its key moving averages, and this is important, if those averages themselves are pointing up. It's also making sure the stock is already well off its recent lows, which helps filter out the wannabes from the true market leaders.
And the last 2 rules really hammer home this buy strength idea. The algorithm only looks at stocks that are hanging out near their 52-week high. And, crucially, it checks their relative strength. An RS ranking over 70 means the stock is performing better than 70% of all other stocks out there. So these were the precise, unemotional rules the bot had to follow.
But here's the thing, and this is so important. A simple checklist, that's not the whole strategy, not even close. There's an art to trading that's way harder to code, and this is where a lot got lost in translation.
This slide just lays it out so clearly. The gap between the master and the apprentice. The human wizard, Minervini, he's dynamic. He's looking at chart patterns, he's reading about the company, he's adjusting his risk on the fly. The robot, on the other hand, is completely rigid. It has fixed rules for everything, from how long a pattern should be to its stop loss. It's a by-the-book rule follower, not an artist improvising.
I mean, the algorithm was missing huge chunks of the puzzle. It had no idea what a company's sales or earnings were. It couldn't react to a massive news story. It was even using a simplified version of that relative strength ranking. The paper itself actually calls it a primitive variant of the real strategy. So really, this experiment was only testing one small slice of the pie, not the whole thing.
Now, given all those limitations, you'd probably expect the robot to fall flat on its face, right? I mean, it's a primitive variant after all. But this is where the story gets really, really good.
The researcher, Patrick Torin, ran an incredibly thorough backtest. We're talking 18 different portfolios across 3 different Nordic countries. He looked at multiple timeframes, covering everything from large-cap giants to tiny small-cap stocks. So, how did our little robot do?
Well, in a lot of cases, the results were pretty underwhelming. Take a look at the Swedish mid-cap market here. The bot's performance? That's the blue line. It barely did any better than just buying the index, which is the red line. It kind of tracked the market, but it was definitely no wizard.
But then, when they let this bot loose on the small cap stocks, this happened. What you're looking at is the Finnish small cap portfolio over 15 years. That blue line is our algorithm. It didn't just beat the market, it absolutely annihilated it. The performance is, explosive is the only word for it.
Let's just put a number to that, because it's kind of hard to believe. If you started with a portfolio value of 100, the bot's strategy would have grown it to over 1,000. In that same time, the index, just buying and holding the same stocks, actually went down a little, ending at 90. The difference is just staggering.
So let's just sum up the findings. The robot apprentice actually managed to beat the market in 14 out of the 18 tests, which is pretty impressive on its own. But the truly game-changing, make-your-jaw-drop wins, they were all concentrated in one specific playground, the world of small-cap stocks.
All right, this is probably the most important part of the whole story. It's one thing to see the results, but we need to understand why they happened. What was the secret sauce with these small cap stocks?
Yeah, that's the billion-dollar question, right? What is it about these smaller companies that made them so susceptible to such a simple momentum-following algorithm?
The research paper offers a few really compelling ideas. First, and this is the big one, market inefficiency. Think about it. Huge companies are followed by thousands of analysts, but small caps, they live in the shadows. Information just doesn't travel as fast, and that creates these little pockets of opportunity. Second, our own human biases, like overreacting to news, might be even stronger with these less followed stocks. And finally, this wasn't just about taking on more risk. The risk-adjusted returns were also way higher, which means the strategy was genuinely more effective in this one specific corner of the market.
So what's the ultimate lesson here? What's the takeaway from this whole story of the market wizard and his robot apprentice?
You know, the paper's own conclusion is probably the most practical piece of wisdom. It doesn't say, fire your portfolio manager and let the bots take over. No, instead, it suggests the algorithm's real superpower is as a screening tool. It can sift through thousands of stocks in a split second to find the ones that meet all the momentum criteria, saving a human trader a massive amount of time. It's the perfect assistant, not a replacement.
And that brings us to this final, really powerful idea. Maybe this whole experiment wasn't really about trying to perfectly copy a trading genius. Maybe the secret it uncovered is that the key to finding a massive edge isn't about building a perfect system, it's about finding an imperfect market to unleash it on.